Right now, as we look at the tape, Pfizer Inc. is trading exactly at $25.33. We are seeing a green move on the intraday chart, up roughly 26 cents, which translates to a 1.06% gain for the day so far. While a 1% move might seem standard for a volatile tech name like Tesla stock or even Nvidia stock, for a pharmaceutical giant like Pfizer, this price action signals something specific about where the floor might finally be for this beaten-down equity. The expectation regarding Pfizer right now is overwhelmingly negative. Most retail traders and even some institutional players view it as dead money, a company that had its moment in the sun during the global health crisis and is now destined for a slow bleed. That is the narrative dominating the headlines in the forums. However, the reality we are seeing on the chart today challenges that view entirely. The reality is that at $25.33, we are seeing a volume accumulation that suggests the smart money is stepping in where the crowd has already capitulated. This tension between the public perception of a dying giant and the technical reality of a stock finding firm support is exactly where the opportunity and the danger lies. When you pull up the chart on your Fidelity mobile app or look at the Level 2 data on your Interactive Brokers trading platform, you are going to see that this $25 level has acted as a massive psychological and technical barrier. The price action today, that lift of 1.06%, is not just random noise. It is a defense of a multi-year support zone. If you compare this to the price action in Apple stock over the last month, you see a completely different story. Apple moves on consumer sentiment and tech cycles. Pfizer is currently moving on a battle for its own corporate soul. The volume we are seeing today indicates that despite the negative sentiment, there are buyers willing to soak up the supply at these levels. We are watching a tug of war. On one side, you have the frustrated long-term holders who bought in the 40s and 50s looking for an exit. On the other side, you have deep value funds and yield hunters who look at a yield pushing 6% and see an anomaly in an otherwise expensive market. This is not just about a pharmaceutical company, it is about market psychology at its most raw. The recent stock movement has been characterized by a series of lower lows, which is why today's push to 25.33 is significant. It is breaking the immediate short-term downtrend on the hourly chart. If you are engaging in self-investing or managing your own portfolio, you know that catching a falling knife is dangerous. But what we are seeing here is the knife hitting the floor and starting to vibrate. The selling pressure that has decimated this stock over the last 2 years is starting to exhaust itself. You can see this in the relative strength index, which has been diverging from the price action. While the price was making new lows recently, momentum was not. That is a classic bullish divergence. It does not mean we are going to the moon tomorrow, but it does suggest that the sellers are running out of ammunition. This is the kind of nuance you might miss if you just glance at the red numbers on a dashboard, but it is vital for anyone looking for investment help or trying to time an entry. Let's talk about the institutional activity, because that is really what moves a stock of this size. You don't move a company with a $140 billion market cap with retail orders on the Robinhood app alone. We have seen reports of activist involvement, specifically Starboard Value, taking a massive stake. When an activist steps in, it changes the calculus entirely. They are not there to collect a dividend. They are there to force change. They want cost cuts, they want strategic shifts, and they want accountability. This creates a floor under the stock because every time it dips, the market remembers that there's a shark in the water pushing for shareholder value. This is very different from the passive investing approach you might find in Schwab Intelligent Portfolios, where the algorithm just rebalances based on sectors. This is active, aggressive financial engineering playing out in real time. The market reaction today reflects a cautious optimism that maybe, just maybe, the management team is finally listening to the pressure. It is crucial to understand the macroeconomic backdrop pressing down on Pfizer as well. We are in an environment where interest rates are relatively high. When you can get a risk-free return of 4 or 5% in treasuries, a dividend stock like Pfizer has to work harder to attract capital. That is why the stock fell so hard. The yield had to rise to become competitive. Now that the yield is high and the stock is at 25.33, the math starts to work in favor of the bulls again. If rates come down, this yield becomes even more attractive. But if rates stay higher for longer, Pfizer's massive debt load, incurred to fund huge acquisitions, becomes a heavier burden. This is the tightrope the stock is walking today. Investors using Fidelity Wealth Management Services or looking at Fidelity mutual funds are constantly weighing this debt-to-equity ratio. It is the elephant in the room. Before we go further into the pipeline, I want to pause and ask you something. Given the massive drop from its all-time highs, do you think the current dividend yield is a trap, or is it the deal of the decade? Comment below how many shares of Pfizer you currently hold, or if you are staying away entirely. I want to see where the sentiment is among real traders. Now, let's shift gears to what this company actually does and why the market has punished it so severely. You cannot discuss Pfizer without addressing the massive void left by the decline of its pandemic-era products. For 2 years, Pfizer was essentially printing cash. That revenue stream has dried up significantly, and the market hates shrinking revenue. It is the cardinal sin of Wall Street. The expectation was that Pfizer would use that massive windfall to secure its future. The reality, according to the market's pricing, is that investors are skeptical about how that capital was deployed. They spent $43 billion acquiring Seagen to pivot toward oncology. That is a massive bet. It is a bet that cancer treatments will replace the revenue from vaccines. This is where the business model gets complex. Oncology is high margin but high risk. Unlike selling a consumer product or a subscription service like you might see discussed on investing sites, drug development is binary. It either works or it doesn't. By acquiring Seagen, Pfizer effectively bought a pipeline. They bought growth. But the market is currently in show-me mode. They don't care about the promise of drugs coming in 2027, they care about the earnings per share today. The skepticism you see in the price of $25.33 is a direct reflection of the market's doubt that this acquisition will pay off quickly enough to offset the patent cliffs facing their older blockbuster drugs. It's a race against time. Furthermore, the operational overhead of Pfizer is massive. When you compare them to a leaner operation or a tech firm, the bloat is visible. This is why the activist angle is so potent. There is a belief that there is a leaner, more profitable company hidden inside the current structure. If management can execute on cost-cutting without stifling innovation, the upside from these levels is significant. But that is a big if. We have seen companies cut their way to profitability only to find they have gutted their future growth engines. This fear keeps a lid on the price. Whether you are looking at this through a Fidelity brokerage account or considering it for your SoFi stocks portfolio, you have to ask yourself if you trust the current leadership to navigate this transition. The sector momentum is also a factor here. Healthcare has been lagging behind technology and communication services. Money has been flowing into AI and growth, leaving value and defensive sectors in the dust. You see this when you look at the performance of Nvidia stock or semiconductor plays versus traditional healthcare stocks. The risk appetite in the market has been geared towards speculation, not stability. However, sector rotation is a very real phenomenon. When the high flyers like Nvidia stock or other semiconductor plays start to look too expensive, capital often rotates back into the dogs of the Dow. Pfizer is currently one of the biggest dogs. Today's move of over 1% could be the early tremors of such a rotation. Funds that track value indexes or dividend strategies are forced to buy when the yield hits certain targets, and we are right in that zone. Let's look at the retail sentiment versus institutional flow. Retail investors, the folks often using Robinhood Cash Management or SoFi Invest, have largely been sellers of Pfizer for the last year. They bought the hype and got burned. But institutional accumulation often happens quietly. While the retail trader is selling out of frustration, the pension funds and the endowments are slowly building positions. They have a time horizon of 10 or 20 years, not 10 or 20 days. They look at the extensive patent portfolio, the global distribution network, and the sheer scale of Pfizer, and they see resilience. They know that even if the pipeline has a few failures, the company is too integrated into the global